Political risk and the management of political risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses political risk and the management of political risks. In this video, you will understand the meaning of political risk, political business risks, categories of political risks, types of political risks, political risk management process, strategies for managing global political risk, strategies to minimize a business political risk, business strategies for dealing with political risks, and phases of political risk management. Now, let us start. What is political risk? Political risk, also known as geopolitical risk, is the risk an investment's returns could suffer because of political changes or instability in a country. Instability affecting investment returns could stem from a change in government, legislative bodies, other foreign policy makers or military control. Political risk indicates the commencement of risk arises due to a change in the governing body of a country and therefore poses a risk to the investors who have investments in financial instruments, including debt funds, mutual funds, and equity. Specific terms like corruption and terrorism are associated with the politics of a country due to changes in a political scenario, which further might result in a change in the nation's regulations. Political risks are associated with changes within a country's policies, business laws, or investment regulations. Other influential factors include international relationships and any other situation that may influence a given country's economy. Political risk is a type of risk faced by investors, corporations, and governments that political decisions, events, or conditions will significantly affect the profitability of a business actor or the expected value of a given economic action. Political risk can be understood and managed with reasoned foresight and investment. The term political risk has had many different meanings over time. Political risk refers to the complications businesses and governments may face due to political decisions. The implication is that political change can alter a given economic action's expected outcome and value by changing the probability of achieving business objectives. Political risk is among the most critical factors facing international investors. In many emerging and frontier markets, the political situation is affected by more than the country's influences. Conflicts in the Middle East, Chinese debt problems, American policies, and disputes over resources around the globe directly affect international investment opportunities. Political risk is an essential factor as the investment time horizon increases. They are considered a type of jurisdiction risk. This is because geopolitical risks arise due to conflict between two countries. There can be hindrance across the businesses and finally the confidence level of the investors. Political risk is an economic change arising from events either directly or tangentially related to the political process. Some examples of events covered by political risk insurance include government expropriation, war, insurrection, terrorism, sovereign payment default, breach of contract, and specific government action, new laws and/or regulations, that can directly affect a company's operations and interfere with its ability to perform critical functions. Let us discuss specific practical examples of political risks. Practical examples of political risks. Example 1. After Donald Trump came into power in the US in 2015, several changes in the trading policies. There has been the imposition of import duties primarily on Chinese goods, which caused a trade war kind of situation, causing a business slowdown for the Chinese companies, further adding pressure to the Chinese investors. The Trump government also imposed strict regulations on the USFTA, which is the governing body of the pharmaceutical sector. Thus, this kind of change in the scenario results in macro risks for the investors. Example 2. The entry of immigrants from Asian countries to several parts of Europe is causing an imbalance in the socio-economic structure of the continent. Thus, there may be a rise in the unemployment of local labor due to the availability of cheap labor from other countries. Therefore, the above situation might cause a positive from the business point of view while it might cause trouble for the local citizen of the country. Example 3. Walmart Stores Incorporated outlines certain political risks it faces in its fiscal 2015 10K filing with the SEC under its operating risks section. In its risks associated with suppliers, Walmart identified challenges to its supply chains, including political and economic instability of foreign suppliers' countries, labor problems, foreign trade policies and tariffs imposed in suppliers' country. In its regulatory, compliance, reputational and other risks section, the company outlines legislative, judicial, regulatory, and political/economic risks. Risk factors mentioned include political instability, legal and regulatory constraints, local product safety and environmental laws, tax regulations, local labor laws, trade policies, and currency regulations. Walmart mentioned Brazil specifically and the complexity of its federal, state, and local laws. Example 4. A typical example of political risk is countries that are in political upheaval. Many countries are experiencing changes in social attitudes and perspectives, causing unrest, changes in politics and political movements disrupting economies. Relatively new to the scene of political risk is technology. The rise in cell phone ownership allows everyone with a phone to be a photographer, journalist, or source of information. Confidence in investments, companies, and countries may be eroded within a matter of seconds of a video being posted online. Categories of political risks. There are macro-level political risks and micro-level political risks. Macro-level political risks have similar impacts across all foreign actors in a location. While these should be included in country risk analysis, it would be incorrect to equate macro-level political risk analysis with country risk as it only looks at national-level risks and includes financial and economic risks. Micro-level risks focus on sector, firm, or project-specific risk. Macro-political risks affect all participants in a country. A common misconception is that macro-level political risk only looks at country-level political risk. The macro-level political risk looks at non-project specific risks. However, the combination of local, national, and regional political events often means that events at the local level may have spiral effects for stakeholders at the macro level. Other indirect political risks include government currency actions, regulatory changes, sovereign credit defaults, endemic corruption, war declarations and government composition changes. These events pose both portfolio investment and foreign direct investment risks that can change investment suitability. Types of political risks. To understand the impact of certain political risks on a business, let us discuss the three most common types with real-world examples. 1. Expropriation and government interference. For no apparent reason or with no justification, foreign governments can seize, confiscate, or otherwise expropriate a company's investment. They can even adopt a series of measures that have the effect of expropriation. In either case, the result is that a firm could lose overseas investments or assets. Real-world example: following a coup attempt in 2016, the Turkish government has targeted those domestic companies associated with the Gulen movement, which it claims was behind the attempt. The actions have included arbitrary impositions of regulatory requirements up to outright expropriation. The impact to Canadian companies has been that they have needed to add a further level of counterparty due diligence to any business dealings with Turkish companies to determine their relationship with the government. 2. Transfer and conversion. During an economic crisis, foreign governments or central banks may impose restrictions or prohibitions on converting the local currency to hard currency or preventing the currency from leaving the country. Real-world example: faced with lower oil prices and consequently dwindling foreign exchange reserves, in 2015, the Nigerian government started imposing capital controls and prevented Nigerian importers from obtaining foreign currency through the banking system. By 2016, this resulted in Nigerian companies being unable to pay Canadian suppliers promptly. 3. Political violence. political terrorism, war, civil strife, or other forms of political violence can damage or destroy a company's assets and prevent it from conducting operations essential to doing business. Real-world example: starting in September 2017, violence erupted in parts of Ethiopia as certain ethnic groups demonstrated against state discrimination. Following months of confrontations between security forces and protests, the country declared multiple states of emergencies. Some international companies, perceived as receiving favoritism from the state, were explicitly targeted by protesters. One lesson for Canadian companies has been the importance of working with local communities and not just the government classification of political risks. Political uncertainty arises from the marketplace of the country. Several businesses surround the economy's marketplace. Change in government leads to a change in regulations and changes in business scenarios. For example, any change in the corporate tax rate by the ruling government can change corporate profits. There are certain legal aspects also which may challenge the way of doing business and lower profitability and enhance risks for the investors. Political risk can arise at a different level at the national level, federal level, and state level. Thus, based on the scenarios, political risks can be classified into two, macro and micro risks. The macro risk is related to the multinational companies which have businesses in the country and the adverse effects faced by those companies, while micro risks arise from internal conflicts such as corruption, poverty, and cynical manipulations. Political business risks. The political risk faced by firms are associated with strategic risk, financial risk and personnel loss for a firm due to non-market factors such as macroeconomic and social policies, fiscal, monetary, trade, investment, industrial, income, labor, and developmental, and events related to political instability, terrorism, riots, coups, civil war, and insurrection. Portfolio investors may face similar financial losses. Moreover, governments may experience complications in executing diplomatic, military, and other initiatives because of political risks. A low level of political risk in each country does not necessarily correspond to a high degree of political freedom. Indeed, some of the more stable states are also the most authoritarian. Long-term assessments of political risk must account for the danger that a politically oppressive environment is only stable if top-down control is maintained, and citizens are prevented from exchanging ideas and goods with the outside world. Understanding risk partly as probability and partly as impact provides insight into political risk. For a business, the implication for political risk is a measure of the likelihood that political events may complicate its pursuit of earnings through direct impacts, such as taxes or fees, or indirect impacts, such as opportunity cost foregone. As a result, political risk is like an expected value. The likelihood of a political event occurring may reduce the desirability of that investment by reducing its anticipated returns. Political risk management process. Steps involved in managing political risks include: understand, analyze, mitigate, and respond to political risks. 1. Understand. It relates to the spread of risk culture to all organization levels thanks to the construction of efficient communication channels. This stage could be supported by insights offered by the organizational behavior field to facilitate the comprehension of external perspectives. 2. Analyze. It means collecting political information in line with the firm's specific needs and plans and fully integrating them in the decision-making process. 3. Mitigate. It is synonymous with identifying vulnerabilities to reduce their exposition, even establishing fundamental relations with stakeholders. 4. Respond. It is related to developing a strategy that responds to failures and whose main pillars are represented by cross-functional cooperation and employers' training. Strategies for managing global political risk. Falling oil prices, plummeting equity markets, social instability, and terrorism, these are some of the political risks facing global businesses today. Such events put pressure on already stagnant emerging economies and lead to potential conflicts between global and regional powers. These risks have only intensified as businesses rely more on international operations to drive profitability. No matter the location of a company's headquarters or the countries that generate the bulk of sales, the business must be prepared for political risk in any part of the world, including countries perceived to be safe and stable. Strategies to minimize business political risk. The impact of any one of these events on a business is unlikely to be isolated or short-lived and may ripple across the entire company and aggravate other types of risk. So how can a business prepare for what may be sudden and unexpected political risks? Here are 8 strategies for protecting a business against political risks. 1. Due diligence. Ongoing research and political risk analysis are perhaps the most important foundational elements of any emerging market business strategy. 2. Consider diversifying local and international investments to ensure that all risks are not concentrated in one or two emerging markets. Have a clear and current political risk mitigation strategy based on your market's what-ifs. Know ahead of time how each unit will respond to a range of risks. 3. If possible, involve critical external stakeholders in political risk mitigation. Brief customers, suppliers, and agents on the contingency plans to deal with unexpected political risk and coordinate the risk response appropriately. 4. Recovering from an adverse political event is likely quicker and easier if the company has prepared a plan to coordinate response with the most critical stakeholders. 5. Manage the credit risk. A government's inability to honor its financial obligations can quickly spread to the private sector. Before a crisis develops, take the opportunity to assess the potential credit risks in the countries where the company do business and review the credit control procedures. 6. Ensure that the company's supply chain can withstand unplanned disruptions. The complexity and interconnectivity of today's supply chains mean that trouble in just one country can disrupt the company's entire global network. The company should also work with risk advisors to develop detailed response plans and consider alternative suppliers or ports. 7. Prepare and protect the company's personnel. Political violence or other instability can develop quickly and with little warning. That makes planning and testing of communications to be essential to protect the company's personnel and contractors. 8. Use the available risk management tools wisely. A credit and political risk insurance policy can cover political violence, expropriation, currency inconvertibility, non-payment, and contract frustration. Despite several geopolitical risks exposure of a business, political risk insurance remains readily available. Insurers continue to view political risk as an attractive line of business and are competing aggressively for a new and existing business. Consider structuring political risk policies to provide coverage for multiple countries, either for a specific region or for a longer list of countries of operation. With some rare exceptions, most organizations can purchase multi-country insurance policies at attractive prices with favorable terms, including broader definitions and multi-year coverage. This might enable the company to obtain protection even for countries where coverage is often difficult to secure on a single country basis. Such an approach can help the organization avoid purchasing coverage for high-risk countries to protect assets everywhere the company operates effectively. Business strategies for dealing with political risks. Here are valuable actions for businesses to deal with political risk based on business-related critical questions. 1. Identify the issue. Political issues affecting a business should be identified. The problem may be a boycott, threat of confiscation, damage to property, imposition of countervailing duty or new labor standards. 2. Define the political and other aspects of the issue. The identified political issue and associated risks should be clearly defined. Is the concern of the government or a major or minor political group? Is there any hidden force or hidden agenda? 3. Was there any past upheaval like this? What was the outcome then? What would be the political fallout if the government sides with the firm or sits opposite? Is there a possibility to settle the issue outside politics? Answers to these questions would assist in addressing specific political issues. 4. Assess the potential political action by other firms and the special interest groups, who are all other parties like us affected. What are their reactions? Will they opt for a coalition of all to mount pressure? How strong are the special interest groups in putting a united face to tone down the issue? 5. Identify influential individuals or institutions. Who are the individuals, public leaders, politicians, elected representatives, regulatory institutional heads? What are the institutions involved, and what are their bargaining powers? 6. Formulate strategies. What are the firm's key objectives and minor objectives in responding to the issue? What are the strategies to cede, supersede or accede? How to break the ice? How to establish contact? How to make the offers of conciliation and reconciliation? Evolve alternative strategies for dealing with affected and aggrieved. Evolve alternative strategies for dealing with those in the front line of confrontation. 7. Determine the impact of implementation. What will be the outcome of ceding? What will be the outcome of superseding? What will be the outcome of receding? Financial, corporate image and relational impacts that should be addressed. 8. Select the most promising strategy. A precise evaluation of strategies' overall costs and benefits should be established in financial terms, corporate image, and relational impacts. Choose suitable strategies and prioritize the expected actions. Phases of political risk management. Political risk handling can be addressed in 3 phases. 1. The pre-investment planning phase. 2. Post-investment operating phase. And 3. Post-expropriation phase. Pre-investment planning phase. A business can adopt the following strategies to deal with political risk at the pre-investment level. 1. Avoidance. Avoidance involves not committing the resources in the project. This is easiest but not reflective of valid business culture. However, certain politically high-risky states, nations and regions can be avoided. The company cannot lose investment with the hope of making a return on investment. 2. Insurance. Insurance involves taking insurance cover the company personnel and property in a hostile country. In developed nations, political risk insurance policies are available, which the MNCs can purchase to cover investments in risky countries. Third world countries also have overseas business risk insurance outfits. Policies that provide for a maximum insured amount and a current insured amount are suitable. Premium is payable on the current insured amount at usual rates. The difference between the maximum and current insurance amounts, known as the standby insurance levels, is that the insurer charges a nominal premium rate. 3. Negotiating the environment. A business concern and the government negotiate on the rights and responsibilities of both and abide by the concession agreement reached. Nevertheless, new rulers may repudiate the concession agreement by the previous government. Such repudiation also happens in democratic countries. 4. Structuring the investment. The host country's project investment can be structured so that the host government intervention costs the government exchequer heavily. This can be achieved by adjusting production, transportation, export, technology transfer and financial policies. The foreign project may be just an assembling unit or just a part manufacturer. 5. Patenting. The multinational company can register its patent generally and make it difficult for host countries to infringe patent and trademark rights. Post-investment operating phase. Political risk can be managed after an investment through the company's operating policies. The alternatives are short-term profit maximization, changing the benefit and cost ratio of expropriation, developing local stakeholders, and adaptation. 1. Short-term profit maximization policy. This policy emphasizes quick return on investments. Having discovered a turmoil political atmosphere, the company can avoid further commitment to a project. This situation might alter the host government's attitude towards capital flights and response to globalization. The company response will depend on 2 bases, shorter payback period and the finite horizon method. Shorter payback period. Projects with shorter payback periods are normally preferred to those with more extended payback periods. On a short-term profit maximization policy. The finite horizon method. This method is similar to the payback method, which can be applied under the condition of certainty. In this method, a terminal date is fixed. In the decision-making, only the expected returns or gain before the terminal date are considered. 2. Changing the benefit and cost ratio, BCR, policy, involves the firm adopting a pro-host country, increased benefit, and reduced cost policy. Policies such as establishing local research and development facilities, export thrust, and technology transfer will help the multinational company negotiate peace with adversaries. 3. Developing local stakeholders management policy, involves the firm creating a customer base, local investor base, and supply chain base so that expropriation and confiscation will be resented to by local customers, investors, and channel partners. It is worth noting that while all subsidiaries face nationalization threats, joint ventures do not suffer such threats. 4. Adaptation policy involves adapting operating policies to the dictates of the political boss. If expropriation is expressed, the multinational company may opt for management contracts and franchising to ensure that the company does not handle the operational aspects. Post-expropriation phase. In the post-expropriation phase, damage control and benefit harvesting exercises need to be pursued. Negotiation, power leveraging, legal recourse and surrender are the options. 1. Negotiation. After the expropriation and confiscation, continued contacts and negotiation with the government help harvest more benefits. 2. Power leveraging involves the firm applying power to the government through diplomatic channels and trade bodies for speedy harvesting. 3. Legal recourse involves resorting to legal remedies to recover the value of the confiscated property. 4. Surrender policy involves giving up the above referred courses and agreeing to salvage the investment. Political risk insurance. Political risk insurance is a tool for businesses to mitigate and manage risks arising from government's adverse actions or inactions. Political risk insurance helps provide a more stable environment for investments into developing countries and unlock better access to finance as a risk mitigation tool. Unlike commercial insurance, political risk insurance aimed to protect businesses and business ventures against perils that other conventional insurance policies would not typically cover. Due to the unpredictability of many political events, political risk insurance offers businesses the ability to cushion the impact and increase long-term durability, mainly when operating in emerging economies. Political risk insurance provides financial protection to investors, financial institutions, and businesses that face the possibility of losing money because of political events. It protects against the possibility that a government will take action that causes the insured to experience a large financial loss. The volatile geopolitical environment can be threatening to global businesses' operations, assets, and people. Companies can purchase political risk insurance to manage their geopolitical risks. Political risk insurance can cover many possibilities, such as expropriation, for example, government confiscation of property, political violence, for example, acts of civil unrest and insurrection, the inability to convert local currency and repatriate it, sovereign debt default, and even acts of terrorism and war. Political risk insurance aimed to mitigate against the loss of commercial assets, income, or property due to a political risk event. The policies can cover a wide range of risks, including political violence, expropriation, currency inconvertibility, non-payment, and contract frustration. Political risks are often complicated and sometimes impossible to predict, and the loss of assets and income arising therefrom may be catastrophic. Buyers of political risk insurance. While emerging markets can present an excellent opportunity for business growth, they also present more significant risks than developed markets. Political turbulence can cause assets to decline severely in value or to be destroyed or confiscated and lose value altogether. Without political risk insurance, businesses would be especially reluctant to operate in developing countries with above-average levels of political instability that threaten their assets and ability to operate smoothly. Political risk insurance is often purchased by multinational corporations, importers and exporters, project lenders, financial institutions and capital markets, foreign investors, and contractors in industries like construction and engineering. Based on the findings of a World Bank survey, investors in financial services are the highest users of political risk insurance. Companies that might purchase political risk insurance include multinational corporations, exporters, banks, and infrastructure developers. Political insurance policies are customized to each client's needs. They can cover one or multiple countries and can have longer terms and multi-million-dollar coverage amounts. The ability to purchase an insurance policy for many years, for example for 15 years, an insurance company, is a key feature of political risk insurance. Many business opportunities require years to achieve, and political conditions can change dramatically in a short time. Suppose a business knows that it will be insured against political risks for years regardless of what happens. In that case, it can confidently proceed with activities that might otherwise be too risky to pursue. Examples of political risk insurance. Political risk insurance can protect physical assets, stock investments, purchase contracts, and international loans. For example, Company ABC, a multinational corporation, has a contract to provide drones to a foreign government. Company ABC manufactures and ships all the drones, but after the shipment, the government becomes insolvent and cannot pay the balance owed. In this instance, Company ABC's political risk insurance would cover the loss. Similarly, a new government comes into power and changes import regulations to mean that the drone shipment can no longer enter the country. Again, Company A.B.C.'s political risk insurance would cover the loss. Another example is Joe's Car Shop, an automobile manufacturer that set up a plant in a developing country and risks losing its plant following a coup in the country. If, after the coup, the national government declares its ownership of all formerly private factories, political risk insurance could compensate Joe's Car Shop for the loss of its plant. What motivates companies to buy political risk insurance? According to the International Risk Management Institution, IRMI, investors and their partners are the driving force behind most political risk submissions. It is often purchased to satisfy the banks, which desire to satisfy internal credit committee lending requirements. It is common for buyers of political risk insurance to pursue political risk insurance only after a political or economic event has occurred. Political risk insurance is ultimately a commodity that is sensitive to supply and demand. Therefore, it would be wise for companies to purchase political risk insurance before the loss of commercial assets, income, and property due to a political risk event. Insuring an investment against political risk requires a proper and precise specification of those political events that are to be covered under an insurance policy. Once a political event occurs, coverage and the exact amount of insurance recovery should not be in dispute. The event in question must have been triggered by political action to receive payment for loss, although the exact meaning of political action is often equivocal. Political risk insurers offer a wide variety of products specifically tailored to any investor's needs and can cover the entire range of politically induced risks. Political risk insurance can be obtained through both private and public providers. Private providers typically offer coverage related to developing and developed countries and the coinciding risk events while conducting business in these places. Most public providers are national export credit agencies, ESAs, which are often intermediaries between governments and exporters. ESAs may cover both export credit and trade transactions as well as longer-term investments. Depending on the risk, coverage can be long or short-term. Trade risk coverage might last for only 30 days, but it could last for several years for major infrastructure development. However, it should be noted that very few insurers will provide political risk insurance coverage for longer than 10 years. The structure of the political risk insurance market. According to Global Risk Insights, two types of political risk insurance providers have two different agendas. The first is the private market, dominated primarily by the London-based Lloyd's market. Other large insurers that offer political risk insurance services include AIG, XL Catlin, Euler Hermes, Star Insurance, and Atradius. There are public, state-backed investment guarantee firms motivated by the government's foreign policy and international development goals. Global Risk Insights explains, these include national export credit agencies, ESAs, like the US's Overseas Private Investment Corporation, OPIC, as well as multilateral like the World Bank's Multilateral Investment Guarantee Agency, MIGA, the Asian Development Bank, and the African Trade Insurance Agency. As state-backed entities, national and multilateral PRI providers can offer longer, larger, and riskier insurance policies compared with the private market. The difference between political risk insurance and political violence and terrorism insurance. There is often a gray area between terrorism and what is considered political violence. How insurers and governments distinguish between the two should inform whether companies opt for political risk insurance, political violence insurance, terrorism insurance, or some form of combo. Because rates for political violence and standalone property terrorism insurance are typically lower than those for political risk insurance, some multinational companies manage the risk of political instability and violence through a combination of the two rather than through political risk insurance. It is, however, important to emphasize that standalone terrorism insurance policies do not cover all forms of political risk. Expropriation, forced abandonment or divestiture, currency inconvertibility, non-payment, and contract frustration will only be covered by a political risk insurance policy. Furthermore, there may be some interpretation about whether a politically motivated act of violence would be covered by political risk, political violence insurance, or standalone terrorism insurance. Conclusion. This video has discussed political risk and the management of political risks. The term political risk has had many different meanings over time. Political risk refers to the complications businesses and governments may face due to political decisions. Political risks are associated with changes within a country's policies, business laws, or investment regulations. Other influential factors include international relationships and any other situation that may influence a given country's economy. The implication is that political change can alter a given economic activity's expected outcome and value by changing the probability of achieving business objectives. There are macro-level political risks and micro-level political risks. This video discussed political risks, types and categories of political risks faced by businesses, and strategies for managing global political risk. I hope the video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.